Hi guys, welcome to this YouTube channel. In this video, we are going to be looking at the smart money concept trade entry models that helps in executing high probability trade setups. The first model we are going to be looking at in this video is actually the CHoCH entry models. And in the coming video, we are going to look at the flip entry models alongside real-time chart backtesting for practical comprehension of this smart money concept trade entry models knowledge. So for now, let's head to the chart so that you would understand the CHoCH entry models in the smart money concept trading methodology. Now, as you can see here from the chart, we have price movement in our lower time frame here. You can see this is our higher time frame supply zone. So you would see that now price have been creating its structure here. Price moving to the upside, returning to rate internal liquidity, push to the upside to rate external liquidity, returning to the downside to rate internal range liquidity. Basically, you know, I've stated earlier in one of the videos in this YouTube channel that the market moves to grab external range liquidity, grab internal range liquidity, move to fill inefficiency and what rate liquidity. That is what basically the market does. So you would see that now this is actually our lower time frame price movements. So this is actually the CHoCH entry model that has to do with the creation of inducements. So you would see when price tapped into our POI, what you would see is that here we actually have a break of market structure before price push into our supply zone, which is actually a higher time frame point of interest. So now we have a break of the last created higher high points, and then price push to the downside. Here you can see this is the higher high point, price push to the downside. Then we have this move to the upside that actually broke this higher high points. So you would see this is not actually a grab of liquidity. This is actually a break in market structure. And then you see that price returned to the downside and then took out this higher low that printed this higher high that broke this previous higher high point. So once we have a break of structure, when price is riding into our higher time frame point of interest, and then price reverse to the downside and then break structure to the downside, we want to wait for price to create a form of liquidity first, and then price should rate that liquidity before we actually have our trade set up to trade to the downside in this particular market condition that we are seeing here. Now you would see what basically I'm saying is we have price push to the upside, we have a break of structure, and then you will see price return to the downside and then broke the higher low point that broke the structure. So you would see this higher high point was actually broken with a candle body close above it. It is not a wick that closed above the swing high points for us to consider it as a sweep of liquidity, as a grab of liquidity. Price pushed further to the upside and broke structure and then mitigated the higher time frame point of interest, and then we see a fall off to the downside that broke the higher low points. So what we want to actually anticipate is to see price create a form of liquidity, so which is actually our inducement. So we want to see a pullback to the upside, and then once we see price falls to the downside, you can see that now price broke this low points created here. So we want to see price return to the upside here to rate the inducement, react into our lower time frame point of interest resting here. Any form of sponsorship can do. It could be our order block, our fair value gap, and then we want to see that now price falls to the downside. So you would see that this market condition is actually the case of CHoCH with inducements. Once price reacts in our higher time frame point of interest, you see we have a break of structure here, and then price returned to the downside and then broke the higher low points. So we want to see that price create a form of liquidity in which price will want to rate before price falls to the downside. Because what we have here is not a sweep of liquidity, it's actually a break of structure. So this is the case of what CHoCH with what inducements. So we are going to check another chart example regarding smart money concept entry model that has to do with CHoCH without what inducements. Now you can see in this particular chart example, we have the CHoCH entry model without what? Inducements. So how do you really consider the CHoCH entry models that doesn't have to wait for the creation of inducement before you actually take your trade entry? You can see that we have our higher time frame supply zone here, our higher time frame point of interest. You would see this is our lower time frame price movements. And now you can see price reacting at the higher time frame point of what? Interest. What you would see is that price created this higher high point because this higher high point took out this inducement and then created this higher low points. And this is a valid higher low point because it pushed to the upside and then swept the liquidity and swept this higher high points, grabbed the liquidity of this higher high points. So now you can see that in this case, when prices come in to react in a higher time frame point of interest, we do not have a breaker structure. What we have here is actually a sweep of liquidity. Basically, this is trying to mean that price here did not print a candle that has a body that closed above this swing high point, meaning this is just a wick that reacted into the higher time frame point of interest, and then price dropped to the downside and then took out the higher low point that printed this higher high point. So we have what? A sweep of liquidity here. Since price have swept liquidity, grabbed liquidity here, then we do not need to wait for price to create a form of liquidity, which is an inducement, before we anticipate price dropping to the downside and then coming to raid the high point of that liquidity zone, which is actually the inducement. So this is what I am actually trying to say. You can see we have price here pushed to the upside. We have dropped to the downside here. And then you see we have price pushed to the upside. Price swept this high points. We have a wick that swept this high points. And then you would see that we have price dropped to the downside and then took out this higher low points. So we do not need to wait for price to create inducements. So when we see price returning to the upside, we would want to take entry within our lower time frame sponsorship candle zone here, and then we push price further to the downside. So we do not need to wait for price to create an inducement and then return to rate the inducement before the fall to the downside. No, price have actually already grabbed all liquidity resting here, swept all forms of retail stack orders resting here, and then pushed to the downside to break this swing point. So our anticipation should be, we want to see price push to the upside to mitigate any form of sponsorship candle resting here and then price drop to the downside. So this is the case of actually the CHoCH entry model without inducements. So I would also want to show us another form of entry model that is also the CHoCH entry model in the smart money concept trading methodology. Now let's look at this chart example of another form of CHoCH entry model in the smart money concept trading methodology. Now you can see this is a higher time frame point of interest. You can see price pushing to the upside here. Price created inducement, price return, took out the inducement. We have this higher low point, push price, took out the external liquidity. This higher high pushed to the downside, took out the internal range liquidity. And then you see we have what? Push to the upside. Now you can see here we have what? A break in market what? Structure. This is not a sweep of liquidity, it's actually a break in market structure. Now you would see that this is actually considered as the inducement. But now once you see price returning into a higher time frame point of interest, and you see that price mitigates the higher time frame point of interest, when you drop to the lower time frame, any form of pullback which is actually serving as inducements that gets violated, gets broken by the return to the downside after price have mitigate a higher time frame point of interest, that pullback can be considered as the swing point that leads to a change in market character. So you can see here what we have is that price push to the upside, return, price push to the upside, give us this form of pullback, which is now when price push to the upside, we are considering this as our inducement. But you can see because price came and reacted within a higher time frame POI. So once price returned to the downside and then rate this inducement, it is now a change in market character. Why? because we have price reaction within our higher time frame point of interest. So since what we have here is not a sweep of liquidity but a break of structure, so we want to see price create a form of what? Liquidity, which is actually our inducements. And then price falls to the downside, breaking the low points of the movement that create the inducements. So what we want to see is after price creates the inducements, we want to see price return into our lower time frame point of interest to mitigate our lower time frame point of interest, and then we see price fall to the downside. So this is another form of the CHoCH entry model. So let me show you in the case whereby price actually sweeps this higher high points, what really you should be anticipating. So in the condition whereby we have price pushed to the upside, we have this pullback, and then we see price return into our higher time frame point of interest. And what we have here is actually a sweep of liquidity. So what we are going to be anticipating is once we see price drop to the downside and take out these inducements, which is now leading to a change in market character. So we do not need to wait for the creation of inducement before price falls to the downside. Once we see price returning to the upside, we can just take our entry from this particular lower time frame point of interest, and then we see a fall to the downside. So we do not need to wait for price to create inducement, because what we actually have here is a sweep of liquidity. Price closed with a wick above this high point, and then we see price return to the downside and then took out this inducement, which leads to a change in market character, because what you have is price already mitigated a higher time frame supply zone. So we do not need to wait for the creation of the inducement, because we already have a graph of liquidity here. So we do not need to see price creating a form of liquidity and then returning towards rate the liquidity before pushing to the downside. So this is the form of CHoCH entry models when it comes to looking at it from the perspective of the market being bullish and then trying to lead to a reversal, which is going to be bearish market condition. So we're going to look at the bullish market condition of the CHoCH entry models in the smart money concept trading methodology. Now you can see this is actually a condition of a selling market, which is going to lead to a bullish market condition. You can see this is actually our demand zone, our higher time frame point of interest. We're going to be looking at this CHoCH entry model with inducements. You can see price falling to the downside, and what you can see we have here is actually a break in market structure. So once price drops to the downside, mitigates the higher time frame point of interest, and then it leads to a break in market structure, meaning a candle body closes below this swing low point, and then you see price push to the upside and then raid this swing high points. So what we'll be expecting is we want to see price create our inducements, and then once price creates inducement, we want to see price return to raid the inducement before we have our buy move to the upside. Basically, this is what I'm trying to point out. You can see that we have a fall of price to the downside into the higher time frame point of interest, and then we have a break of structure. And then what we are going to see is that we see price push to the upside and then rate this high point that printed this lower low point that broke structure. So since this is not a graph of liquidity, we want to see price create a form of liquidity, which is our inducement, push to the upside. So once price now creates our inducement, we want to see the return of price to actually rate this inducement to mitigate the lower time frame point of interest here. Then we're going to see price drop like this. Then we take our entry from this lower time frame point of interest, and then we journey with price to the upside. So this is the case of CHoCH with inducement in the condition where the market is actually bearish, and then we are looking for a bullish reversal. So let's also check the condition where we have the CHoCH entry model without inducements in a bearish market condition where our anticipation is to expect the bullish reversal. So now you can see from this chart example, we have the CHoCH without inducements. You see we have a bearish market condition, price returning to a higher time frame point of interest, our demand zone from the higher time frame. This price movement we are seeing here is actually our lower time frame price movements, the time frame in which we're actually anticipating to take our trade entry. So you would see what we have here is price have been bearish in this condition, taking out external range liquidity, taking out internal range liquidity. And now you see what we have here is price swept this low point, meaning price grabbed this liquidity. What we have here is a candle that's closed above this swing low points, but the wick raided the low points. So we do not have a body candle close below this swing low point. What we have is the wick that took all form of liquidity resting here, because now you would see that now price dropped to the downside into the higher time frame POI, and then you see we have the push to the upside here that took out this high point that printed this low point that took out this liquidity. We do not have a break of structure here. What we have is what the graph of liquidity, the rate of all forms of what retail stock orders resting here. So you would see that now we have price push to the upside, and then price changed the character of the markets, because you would see that now price rated this lower high point that printed this lower low points. So in this condition, we do not need to wait for price to create inducement and then anticipating that price comes back down to the downside to rate the inducement before we buy to the upside. So what we can see is once price takes out this liquidity, push to the upside, break structure here, what we're anticipating is the return of price to the lower time frame point of interest or any form of fair value gap that we have resting above. So we want to see return, and then we push price to the upside. We do not want to see price create any form of inducement before we now want to see price return to rate the inducement, mitigate the lower time frame point of interest, and then push to the upside. No, because what we have here already is that price already took out liquidities resting here by these price movements that wicked this lower low points. So this is the form of what CHoCH without what inducement in a bearish market condition in which we are anticipating or expecting a bullish market reversal. So let's check another chart example in reference to where our inducements swing points becomes our words change in market character swing points. So let's look at this market condition where our inducement swing points leads towards our change in market character. Before we continue, kindly like this video, guys. Subscribe to this YouTube channel if you're new to the channel. You can also share our videos to help us reach a lot of other people out there who are actually having difficulties in understanding how to interpret price movements in the markets. And I want you to understand that I want you to really comprehend this knowledge, as the next video will be real-time chart examples we're going to be handling, basically applying what we are actually going to learn or we are already learning from this video. So now let's look at this price delivery here. You would see that what we have is price falling to the downside. You can see we have a higher time frame point of interest. Now you would see that now when price dropped to the downside, price created our inducement, and then we have pushed to the downside that broke structure to the downside. You already know that what this is actually our inducements. So what you'll be expecting is you want to see price return to the upside and then rate the inducement and then fall further to the downside. But what you must put in mind is price mitigated the higher time frame point of interest. So once price breaks this inducement zone, that becomes our change in market character, because we have already price mitigating a higher time frame point of interest. So what we are going to be anticipating in this condition is to see that price create our inducements, since what we have here is a break of structure and not a drop of liquidity. So once price creates the inducement, we want to see price return to rate the inducements to mitigate the lower time frame point of interest resting here. So you see price return into this, then you can now take your entry here and set your stop loss below the swing low of the lower time frame swing points, and then you see we have what price push to the upside. But in the case where we have this as a sweep of liquidity, then we do not need to wait for the creation of what inducements. Just the way I've explained from the previous CHoCH entry model, when it has to do with a bullish market condition leading to a bearish market with reversal condition. So this is how we look out for the CHoCH entry models. So let me actually show you guys a candlestick chart example so that you would understand this even as we prepare to come up with the next video where we'll have a real-time chart example that actually practically explain the CHoCH entry model. Also, we are going to look at the flip entry models in the next video. So guys, let's look at this example that has to do with the candlestick for you to actually understand what I am actually explaining with the previous price diagrams I use in explaining the CHoCH entry models. So you can see here we have price pushing to the upside. We have our move to the upside here. We have price push to the upside here. We have this pullback because this rated this low. We have this pullback and then we have price push to the upside. You can see we have the return that rated this inducement and then we have price push to the upside. We have this pullback, which is actually an inducement, took out this low point. Then we have price push to the upside and then price return and took out this inducement. Now you can see we have now price push to the upside. What we actually have here is actually what the break in market structure, because you can see this candle created a body that closed above the swing high points, and then you can see price react within our higher time frame point of interest. So once we have the reaction of price within our higher time frame point of interest, you would see that price dropped to the downside and then price took out this low point that sponsored the move to the upside that took out this high points. So you see what we have now, we have the change in market character here. So you would see that now price dropped to the downside, created a change in market character because you can see this is a candle body closed below this low points. So what we are going to be anticipating is to see price create what's inducements, because what we have here is that what price broke structure here. Price did not grab liquidity here. What price did is break structure. What price did here is to break this structure and then push price again to the downside and then took out this higher low point. So you can see that now price created a form of what liquidity here, which is actually the inducements, because once price created this and dropped to the downside, what traders will be expecting is they want to see price possibly come to this zone here and then react to the downside. But no, price would not do that. Price regarded this as what inducements, and then you would see that what happened was once price dropped to the downside here, price returned to the upside, raided the inducements, mitigated the lower time frame POI. You can see we have our ideal order block here because you can see we have what's a fair value gap left here, price imbalance. We also have price imbalance here. So price return and then we now see what's the fall to the downside. So this is what the CHoCH entry model with inducements. We have price break structure, mitigated the higher time frame POI, price returned to the downside and then broke the previous higher low point that printed this higher high that took out the previous higher high. So once price broke that swing point, we want to see price create a form of what inducements, a form of liquidity, which is what our inducement, and then price should return to raid the inducement and then fall to the downside. So we are going to check this examples, this theoretical knowledge in a real-time chart example for you to actually see how this is applicable to the price charts and how to actually use this to effectively execute high profitable trade entries. So you can also see, let's check this without words, a CHoCH entry model without the inducements. So what you would see is we have price push to the upside here. We have our pullback because this rated the low of this candle. So we have this pullback, price push to the upside. We have this return that took out this inducement, this internal range liquidity. And then we have this movement and then this return and then price push to the upside. You can see we have this deeper pullback that took out this liquidity resting here. which is actually our inducements. And then you see that we have price push to the upside. What you would see here is price raided this higher high point with a week and then reacted within our higher time frame point of interest. We have what? A sweep of liquidity, price reaction within our higher time frame point of interest. So what we are going to be anticipating or expecting is, now once we see price return to the downside and then price breaks this low point that sponsored the move to the upside, that took out this higher high points by sweeping all form of liquidity resting here. So you would see that now we do not need price to create any form of inducement, because what we have here is actually what? A sweep of liquidity here. So what we'll be expecting is we just want to see price return into the lower time frame POI, and then we have fall of price to the downside. So you would see this is not actually an inducement here, because you would see that this is the lowest candle, and then you can see that the high of the candle is actually protected here. You can see the high of the candle is protected. So this is not an ideal pullback, because the high of this last bearish candle was not rated by this move to the upside. So meaning this is just a single leg move from this point to this particular low point is just a single leg move. So you can see then we have price return into the lower time frame point of interest, and then we have the fall of price to the downside. So this is the case of CHoCH without what? Inducements. So guys, please stay tuned to this YouTube channel as we bring the next entry model for the smart money concept trading methodology, which is actually the flip entry models. And after teaching that, we are then going to look at real-time chart example to apply this knowledge that we have actually gained from this particular video. And hey guys, if you are just new to this YouTube channel, please kindly subscribe to this YouTube channel, like our video, and also share with friends and families who are actually interested in learning how to trade the financial markets. So cheers guys, and God bless you all.